Fireside Chat with Mr. Mark Mobius. So this will be moderated by Mr. Shyam Sekhar, founder of iThoughts. So he is a renowned value investor with over 3 decades of experience in financial markets. His focus has been on identifying investment opportunities in emerging companies through a sound research-driven process. Thank you so much, Mr. Shyam, for joining us today. We're really looking forward to the last and final session. And Mr. Mark Mobius, founder of Mobius Capital Partners, joining us today for a very, very special interactive session. Dr. Mobius has actually spent over 40 years working in and traveling throughout emerging and frontier markets. During this time, he has been in charge of actively managed funds totaling to $50 billion in assets. Prior to launching Mobius Capital Partners in 2018, Dr. Mobius was with Franklin Templeton Investments for more than 30 years, most recently as executive chairman of the Templeton Emerging Market. So it is truly an honor for you having accepted our invite and choosing to speak with us today, Dr. Mark. Thank you so much for joining us.
Thank you. Nice to be with you.
Thank you so much. And over to Mr. Shyam. Thank you.
Thank you, Shruti. Good evening, Mark. It's a pleasure talking to you. I met you in 1993 when FIS first entered India. I met you in Madras, which it was then, and today it is Chennai. And I still recall how you were very warm and interactive to us when we spoke to you. Without wasting much time, let me start the chat. Growth versus value. The debate keeps reviving every decade. How do you see value investing play out in the next decade?
Well, the concept of value investing now is changing. As you know, in the past, we always were looking, frankly, through the rear view mirror. We kept on looking back to see, okay, what are the earnings last year, the year before that? And then we say, okay, let's do a discounted cash flow going forward. And the emphasis was on the relationship between the price and the earnings, or the price and the book value. The problem with that concept under this new era of internet transmission and the fast-growing companies in the internet space, or the technology space, is that it does not take into account what we're going to be looking at in a few years from now. Oh, yes, we were making projections in the past, but we were not looking at the right things. Let's put it that way. We were not looking at things like return on assets. We were not looking at things like the particular technology that was being used by a company. So the whole concept of value has really been changing. Now, I wouldn't say that value is out the window. Of course, value is important. We have to have value, but we also have to have growth. And we were, frankly, overlooking the growth aspect in the past. And now we're looking more and more at that aspect.
Passive investing and index funds have marked a big presence in India in the past few years. Do you see passive investing beat active investing on a sustained basis in India?
Well, I know that passive investing has become very, very popular. ETFs, exchange traded funds, have grown dramatically. And the whole theory of passive investing was that you had no hope of doing better than the market. In fact, that's what the academics were saying. And therefore, you might as well throw up your hands and buy the market. Well, the reality is that you can do better than the market. If you do consistently smart and diligent research, you can do better than the market. And also, the other factor, of course, that made passive investing so popular was that it was cheap. ETFs, exchange traded funds or index funds, their total expense ratio might be 0.2 or 0.3, 3 basis points, 0.3%, whereas active investing costs more. I remember our total expense ratios for some of our funds was as much as 3%. So that was a real challenge. And of course, we had to outperform the compounded 3% expense ratio going forward. And that's not easy. So that was really the reason why we've seen this explosion in passive investing. Now it's beginning to dawn on people that maybe that's not the right solution, that you have to get involved with active investing, but the active investing has got to be at a right price. It can't be so expensive as it was in the past. So you've seen active investors' fee structures coming down, but not as cheap as the passive investing, but that's helped a lot to get people involved in active investing. But I do believe that active investing is here to stay. And of course, there is some room for passive investing if you're interested in a particular sector or so forth. But you're going to see both of these living side by side.
How do you see the global liquidity scenario going forward? How will it affect India's long-term growth story?
The liquidity situation globally is very, very conducive to the emerging markets area, particularly those emerging markets that need liquidity, that need finance. The reason for that, of course, is that the extremely low interest rates in Europe and America and Japan means that investors are searching for a yield. I just read, by the way, that the sovereign bonds, I think it was 10-year bonds for Portugal, are now minus, no longer positive. And now Portugal is not necessarily the greatest country in the world, but you can see that these rates have continued to go down. So for a country like India, it's an incredible opportunity to go into the financial markets and gather up some of this liquidity and put it into infrastructure spending, which India, as you know, needs very badly. I think, a 50-year bond, a 100-year bond for India would make a lot of sense, and it would probably attract a lot of investors at low rates of interest. And it's very sustainable for India to do something like that, because particularly if you do the infrastructure spending on a pay-as-you-go basis, in other words, toll roads, toll bridges, etc., it should be no problem at all. So it's a wonderful opportunity.
Given that stocks have rallied smartly on the back of global liquidity, do you see this rally spreading to other asset classes like commodities, real estate, and gold?
Oh, yes, of course. You've already seen it in real estate. In many countries, real estate prices have gone up dramatically because people can get mortgages so cheaply. Gold, as you know, has done fairly well because people are afraid of currencies, generally speaking, for good reason. And commodities, gold being, if you consider gold a commodity, of course, I consider gold a currency. But if you look at commodities generally, those prices will probably rise if they have not done already. Of course, oil is problematical because you have an incredible technology now that you're able to get oil out of stone, basically. So it's probably not going to rise dramatically, but it will probably rise.
Commodity stocks seem to be the most ignored part of the equity universe. You mentioned that it's a good time for capital-hungry businesses, but with USG investing becoming very popular, has equity investing turned its back permanently on commodity stocks?
Oh, no, I don't think so. It was very interesting you mentioned that because I was interested in looking at a company in Chile, SQM, who are big producers of lithium. And as you know, lithium is in demand now because of the electric cars. And their stock price has recently done very well. So I don't think it's over. There are a number of opportunities in the commodity space.
You had mentioned oil. We have seen oil go weak and come back in the past. It had brutally volatile cycles. Do you think that those volatile cycles are a thing of the past, or you think they can still repeat, but maybe in shorter bursts?
They still can be repeated in both directions. For example, let's say, again, this is a speculation. Let's say that Biden becomes president and he decides to change his attitude towards Iran and reverse Trump's policies. Iran could become a major exporter of oil. That could drive prices down. So you could see some volatility happening there. On the other side, if there is for some reason some problem in production in any part of the world in some of the major producers, then you could see oil rising again.
Which are the best geographies to invest in the post-COVID world, and how do EMs compare with the developed markets?
Well, I believe because of the reasons you mentioned regarding liquidity, and also because of the growing weakness of the US dollar, the opportunity in emerging markets is very, very good now. And if you look at the index of emerging markets, you'll see the performance has been outstanding. And by the way, there's a big difference from the last 10 years. As you know, the last 10 years, emerging markets have not really done that well against the US market and the world market, but now emerging markets are coming back.
So you feel the trend will further gain momentum in the next few years? You feel that this trend is going to gain momentum because of the liquidity?
Yes, as long as this liquidity continues to be priced at so low a rate, and also as long as these emerging markets recover from COVID, then they should do quite well.
The post-COVID economic recovery of different nations varies. Each is different. The distinctive difference is visible to us. What will be the key drivers for nations to ensure a timely economic recovery? And how do you see India in our economic preparedness?
The key driver, of course, will be a return to normality. And that is the end of COVID lockdowns. The biggest problem facing the world today is the reaction of governments around the world to lock down their populations. And that means, you have no business going on. You kill the retail business in particular, but other businesses as well. As you know, in places like Singapore, the lockdown has had an incredible impact on the earnings of Singapore Airlines. I was just talking to someone in Singapore. The retail trade is in big trouble. Along the famous Orchard Road, some of the retailers will probably go bankrupt. And if that happens, that would be a big disaster for Singapore as a big shopping center. So, and this you see around the world, not only in Singapore and other parts of the world where there's been a severe lockdown. So the first order of business for governments around the world is to end the lockdowns. And of course, that does not mean you open everything up and you increase the risk of contagion. But what you do, like here, I'm in Dubai. I entered the country after having had a test, which was negative. So they allowed me to enter the country, and I'm able to go about my business, of course, wearing a mask wherever I go. Whenever I leave the hotel room, I wear a mask just like everybody else. But otherwise, life is back to normal. Of course, it's not been fully recovered because there's so many people around the world who are afraid of traveling. And of course, they also have to have this test, which may not be easily available. But anyway, it's a step in the right direction. And I believe that is the way we're going to see the world operating come January of this coming year.
You have seen several situations where a market runs ahead of its fundamentals. When a market runs ahead of its fundamentals, how should an investor play this situation? Should he sell and stay away? And when an investor knows valuations are high and markets are still showing no sign of correcting, how should he play this situation? Should he stay in the party as long as it lasts?
Yeah. Well, it's difficult to say if markets have gone above their fundamentals, because you remember in February, March this year, the markets plunged dramatically. And of course, there was a wonderful opportunity to buy stocks. But you must remember that most markets, if not all, I would say, have not recovered fully to where they were prior to the COVID scare. So you could say that most markets are not reflecting their true value yet. So I believe that we still could have a way to go. And if the recovery, the V-shaped recovery, which I expect to take place next year, if that does take place, then we could see a very booming market. But I must say that this kind of prediction, of course, has no basis in reality if tax rates in America go up under the Biden administration, and if taxes in Europe also go up, because that will mean people retreating from markets. And of course, that will not be good for emerging markets as well.
You've been coming to India for the past 3 decades. How do you see India's future against its past?
Oh, it's got a tremendous future. It's incredible. India is one of the greatest beneficiaries of the technology revolution that's taking place around the world. And Indians are particularly capable of taking advantage of this incredible revolution. That means lower prices in real terms and big growth prospects for every industry in India. So the prospects are very, very good.
Having been a keen watcher of liberalization, can you share your perspective on what India has done right?
I think what India has done right is to move more and more towards favoring the private sector in reducing regulations, in reorganizing the tax system. Of course, there's a lot more to be done, but reorganizing the excise tax, as you know, so that the infrastructure can work more efficiently with transportation from one state to another. There are many of these things that are happening in India. It's, of course, a long way to go, but we're moving more and more towards a digitalized India. And that, of course, will mean a more unified India and a more prosperous India. So I believe the opportunities are there. And under the Modi administration, you've seen a government which probably for the first time was embracing the private sector in a positive way. And that's very important.
And what did we do wrong in our post-stabilization? What are the things that we really got wrong?
Not enough privatization of state-owned enterprises would be the first one. And the second one would be a reduction in the lack of reduction in government regulations that impede the industries. Now, as I said, a lot has been done, but a lot more has to be done. And one of the big mistakes since independence, by the way, has been the lack of action to reduce bureaucratic hurdles for business.
My next question on what needs to be done to reach our potential.
Well, I think continuing the same progress that you've had. In other words, keep on the same track. More liberalization, simplified procedures for businesses, more unification of the tax system, and infrastructure spending. Infrastructure spending is so important, and I believe with low interest rates globally, India could raise a lot of finance, long-term finance for infrastructure, which is so important for the country.
Government still has a very big role by being in business, while there is a realization in government that they must not be in business. Disinvestment seems an uphill task. Do you see India succeed in disinvestment? Is there an appetite?
I think they can exceed. You see, the problem in privatization, as you know, is that government officials, rightly so, are quite concerned about giving away the crown jewels. Let's put it that way. In other words, they don't want to be seen as selling state assets cheaply. So that's the real big issue. Now, the way other countries have tackled that problem is by maintaining some government ownership in the privatized industries. You've seen that in China in particular, where they said, okay, we're going to run this company as a private company with top management and so forth, and we'll maintain 30%, 40%. And so if people accuse us of selling too cheaply, we can say, look, we're still getting the benefits of the business. So you can't say that we sold too cheaply. So this is one of the ways that you can surmount that criticism and the fear on the part of people who are involved in privatization.
So you're talking about strategic sale and control, where you still own shares, but you allow the private entity to run the business. That is what is
Exactly.
key via Mobius.
Exactly.
Do you see the government doing enough for disinvestment, or is there something else which they could do other than this strategic sale with control model?
I think the other thing they can do is really help the small and medium-sized businesses. Big businesses in India are already big. They're doing quite well. They don't need help. It's the small and medium-sized businesses that need help. So what has to be done is go out and talk to these people and inquire as to what they require as to improve their business environment. And I'm not talking about handouts. I'm not talking about subsidies. I'm just talking about anything the government can do that will make these businesses easier. It could be something about taxation. It could be something about regulation. It could be a number of things like that. But I think that's something that could be very, very important to the growth in India. Because after all, if you look at the Indian economy, it's made up of small and medium-sized businesses. And those are the people that provide the dynamics of the economy.
If you look at the public sector stocks, the PSU stocks, we are seeing a level of gloom now which has no parallels. Do you think this gloom can be changed? What do you think can change this gloom?
Again, the whole idea of privatization is really about corporate governance. So one of the main targets that can be focused on would be the directors, board of directors, and people who are in charge of the companies to ensure that these people are independent, so that you can have a more logical and logical system that will be much more conducive to private sector operations. So I think corporate governance reform is number one on the agenda.
Mark, you have been always positive on the India story. Even now, India is your top EM pick. What makes India your favorite market across decades and across market cycles?
Number one, size. You've got a huge population. Number two, a young population. Number three, a population that, although have many languages, for the most part, can understand and speak English. Number four, an incredible history, a varied, rich historical background and cultural history, which is conducive to more creativity. So I would say those are the four aspects that I think are very important.
I'm going to just add one question to you on India, which is again very, very relevant because we have had one part of India, which is the south and the west, which are far more economically developed than the north and the east. Do you think that development of the north and the east is more central to India's economic progress further, or is it sufficient to just keep going as we go, as we have done in the past?
No, I think you got to focus on all parts of India, because if you don't, you'll have too many differences, and that will not be conducive to peaceful India. In other words, you're going to get a lot of people unhappy. They will strike, they will riot, and so forth. So you've got to focus on progress for all of India. But I must say that if you look at a place like Calcutta, which was normally considered sort of not very developed, but you notice that the technology sector in Calcutta has done very, very well. So that's an example of, an eastern part of India that's doing very well. And I believe the same thing could happen in the north, in other parts of India. The key, of course, is to get the state governments on side, to get them to think about reform. And it's not easy because some of these states have embraced socialism, communism, and other isms that are not conducive to the private sector. So I think that's the story that has to be told.
My last question. What would be your advice to all the young investors who are starting today? You still look very young and you still look the same. When I saw you 27 years, you look the same. What would be your advice to the young investors? What do you think they should be doing now for the next 20, 30 years?
What the young investors should do is study, read, and learn as much as you can, not only about the market, not only about economics, but about culture, so that they can be creative. At the end of the day, the most successful investors will be those that are creative, that can look at things from a different viewpoint. Of course, you've got to know the mechanics of investing. You've got to understand how the markets work. But the most important thing is to be creative and think out of the box, so to speak, and think differently from other people, and being willing to go against what other people are saying. Because, the best way to make money in a market is when other people are selling, and selling when other people are buying. So that's the advice I would give for the young generation.
On that note, I want to thank you, Mark, for your wonderful answers. I'm sure that everybody is richer with your experience and sharing of your knowledge. And it was a pleasure for me to talk to you today, just as it was 27 years ago when I met you. And I'm always thankful to you for your warmth and your very open and evocative style of answering.
By the way, I don't know whether you know, but Madras was the first place I went to in India many years ago. It was the 70s. And I was there as a UNDP consultant. And it was quite an experience. It was my first experience with India. So thank you very, very much.
Thank you. Keep coming.